Hi, I'd like to welcome everyone to the Tax Saving Tip webinar this afternoon. My name is Sarah Schaefer, and I will serve as the moderator for today's webinar. So how it will work is we have a recording of Paul Neiffer from the Top Producer Seminar where he details a lot of tax tips and tricks for farmers. And so we'll watch this webinar, which is about 40 minutes, and then Paul will be on the line for a live Q&A. So for our attendees, you can at any point type your questions into the comment question area, and then I will compile those and have those ready for Paul during the Q&A portion. So at any point, you can drop those in there when you think of them, and we'll have them ready for him at the end of the broadcast. During the Q&A portion, we also have the opportunity where I can unmute you if you raise your hand, and you can ask the questions directly to Paul. So it's a great opportunity. You can ask him very specific questions about your operation or your tax situation. So without further ado, we'll go ahead and start the live broadcast and be ready for questions.
We grow a lot of apples out there. I'm Paul Neiffer from Yakima, Washington, which is, we grow a lot of apples out there. I'm with Clifton Larson Allen. Now, let me just give you a little background on that. We were sort of talking it over before we got started here. This is a merger of Larson Allen, which from the Minnesota New Ulm area. We have an office up there. It's a merger of Larson Allen with Clifton Gunderson, which Princeton, there's a good-sized office there. It was effective exactly a month ago today. We're going to be about $600 million in revenues and about 3,600 employees. We're in 25 states, and we have a pretty high concentration of offices in the Corn Belt or in the Midwest. One of the things that sort of differentiates us from other firms that are in the same size of us, we're the largest CPA firm that our primary focus, or almost our exclusive focus, is on privately held businesses such as farms and farmers. A lot of those other firms that are our size do a lot of SEC work, and we don't do any of that. That's a little map. Up in that Washington State, up in the upper left-hand corner, my office is about, it's probably the farthest left and south, but I spend a lot of time in the Tri-Cities area too. Here's our objectives today. We're going to go over and there really isn't too much that's new for 2012. I mean, last year at this time, there was a lot of new stuff. Matter of fact, we just had a brand new law that was passed less than a month before we had the Top Producer Conference last year. We got, whether we want to, unless Congress changes and the President changes, and even with that, I don't think it's going to happen. We're going to have a Medicare surtax that's going to possibly hit you guys starting next year. We'll go over how to maximize your tax-free fringe benefits when we had the Tomorrow Top Producer on Tuesday. I had a breakout session on that, and I spent a lot of time on that. We won't spend as much time today on that. Farming is unique, or probably more unique than other businesses, in that once year-end rolls around and you go into your CPA to get your tax return done, you have a lot of planning opportunities to I guess, use the word manipulate your income to where you want it to be, unlike a lot of other businesses. So we'll go over that. If we have time, and I think I probably won't have time to get through everything, but hopefully I do. We'll go over what's the best entity for your farm operation, and then other farm tax tips and traps. What's new for 2012 and 13? Okay, we were sort of talking about that a little bit. Section 179 drops from, what is it this year? 500,000. That's the biggest it's ever been by far. Drops from 500,000 down 139,000. And if you guys buy two brand new combines or two new tractors, you're not going to get Section 179 depreciation at all. Because once you hit 560,000 plus 139, so it's 699. If you spend $700,000 on equipment, you can't take Section 179 this year. Bonus depreciation, we still have it. It's just instead of 100%, it's going to be 50%. And again, it applies to new assets only. And new technically means it has to be new. It just means it has to be new for that use, such as, let's say that you have a car dealership, or let's say you have a local combine dealership that may demo a combine for 20 hours or 30 hours during the summer before they sell it. The farmer that buys that combine, it still qualifies as new. This is one thing where I won't say we get in arguments, but we certainly have discussions with other CPAs that aren't really as familiar with farming, but all farm buildings should qualify. That means machine shops, and the one where they want to get in an argument, if you have a C corporation and you've built a house to provide corporate housing to you or to other employees, that is a farm building. If it's newly built, it's going to qualify for 100% bonus depreciation in 2011. This year it'd be 50%, but that'd still be a pretty good deduction. And this is sometimes when CPAs put their earmuffs on and don't want to hear anything. It's got to be placed in service. That means it's supposed to be delivered to the farm. The purchases on December 31st. Hopefully they've been delivered to the farm. Of course, then the people ask, well, what if it's not going to be built until 2013? Well, then you're in trouble. There's a new credit that started in 2011, basically. There's a new hire credit that you take advantage of on Farm 5884B. This was, I think, clear back in early 2000, that if you hired a new employee that had been unemployed for 60 days, and they verified that by filing a Form W11, you got a payroll tax break back in 2010. Well, if they were hired for a whole year, and you kept them on for a whole year, you're entitled to a new $1,000 credit on your tax return. That's for this year. Most farmers, the DPAD, U.S. accountants, we like to abbreviate things. That stands for the Domestic Production Activity Deduction. That's that 9% deduction that you get basically on your net farm income. You get to take 9% of that as a deduction on the front page of your 1040. That's still at 9%. I'm guessing next year, year after, that deduction may go away. There's talk about that right now. The one area where us as CPAs, especially if we don't do a lot of farm accounting, can sometimes get tripped up is we forget to take a look at farm income averaging. And this year where you guys possibly, unless you guys are really taking advantage of bonus depreciation, you possibly have higher income, you definitely look at your farm income average. It can save you a lot of money. Capital gains and qualified dividends are still taxed at the maximum 15% for this year, plus whatever your state rules are. Everything I'm talking about basically is going to be federal rules. If you have a C corporation, we try to get those earnings out, but that's a double tax law. It's only 15% right now. Next year it's probably going to go back to being ordinary income rates. Consider doing that. Sell some capital assets before year end. Or remember, if you're in the 15% tax bracket, so let's say the 15% tax bracket for a married filing joint stops at $70,000, and you go through all your deductions and everything, you're at $50,000. That difference between $50,000 and $70,000, if you have a long-term capital gain, that's taxed at 0%. So if you are still in that 15% bracket because you've taken advantage of all the bonus depreciation and you have a C corporation, kick out a dividend. And you can do that after year end. You can just simply do that on the tax return. It's real easy to do. But, and that's one thing. When you get your tax return back from your CPA and you have a C corporation, you have a personal return, it pays to take a look at that, because when we get in the heat of battle, especially around February 28th, 29th, or March 1st filings, it's very easy for us at times to miss something like that. We're not perfect, believe me. Okay, here's something with the rapid run-up and this is an estate planning class, but I'm going to go over it with the rapid run-up in farm values. This is a $10 million. If you take advantage of a properly structured entity such as an LLC or a limited liability partnership, etc., you could probably get pretty close to gifting up to $20 million and not pay any gift tax. And again, everything I'm saying, I'm talking more at the federal level. A lot of states don't even have a gift tax. They have an estate tax or an inheritance tax, but they don't have a gift tax. So that's another reason in those states it's better to do a gift than to do, or wait until you're dead. Now, the negative about this, potential negative, is when you do a gift and you paid $500 for that land per acre and it's worth $10,000 an acre, what's your basis when it's gifted over? It's the 500, not the 10. But if the goal of the family is that that farmland is going to remain in the family for the rest of time, do you really care what the basis is if you're not going to sell it? Or do you want to have a disincentive for the non-farm heir not to sell it anyway? Because if they sell it, they're going to have to pay a bunch of capital gains tax. I mean, that's not... For a lot of other businesses, that's a negative. For farming, it may or may not be a negative. And the annual gift exclusion is still at $13,000. I think it's going to go to $14,000 next year. They have an inflation factor, and it has to go up by at least the next above $14,000, then around back to 14. I think right now it's at 13.8 or something. So if I own, let's just say I own 1 acre of land. It's tough to do that, farmland, but let's say I want to own. Actually, I do. I own 1 acre of farmland, and I paid 30 years ago $500 for it, and it's worth $20,000. Let's just use 1,020. If I give it to you, my basis of $1,000 an acre carries over to you. Now, if I die and you inherit it from me, you get to step it up to the $20,000 value. And so when you sell it the next day, if I gift it to you and you sell it the next day, you got a $19,000 gain. If I die and you inherit it the next day and you sell it for $20,000, you got no gain. That's why most of the time we tend to want to focus in on transferring property at death because you get a step up in basis versus gifting it. But again, go ahead. Right. Well, and that's another reason why sometimes it's, especially if you get in bigger states, if you own 3,000 acres of farmland right now, and it's free and clear, and it's in Iowa, and it's in Grundy County, it's worth, what, $30 million? We're getting pretty close. I mean, those are getting to be big numbers. A lot of times as advisors, especially if you have outside liquidity, which most farmers don't, but as advisors, we have a lot of people that have outside liquidity. We tell them to make big gifts now, pay the gift tax, because that reduces their estate. Here's a big thing that's going to be applicable, especially with the surtax thing starting next year, is grouping elections for passive activities. Right now, a lot of our planning has been the farmer's operation is in either a C corporation, it's in an S corporation, it's in a partnership, and the farmland that's owned by the farmer is in an LLC. And the reason we do that is the rental income from the LLC is not subject to what tax that everybody hates, the self-employment tax. It's exempt from self-employment tax. Well, the new Medicare, and I'm going to go into that next, the new Medicare surtax says that if your income is above $250,000 for married, that excess amount of rental income above that amount is going to be subject to an extra surtax of 3.8% if it's rental income. Now, if we make this grouping election, because really what we're saying when you make the grouping election is that Farm S Corporation and that Farm LLC that owns the real estate, it's really one business, isn't it? Same ownership. It's renting its land from the LLC over to the S Corporation. And so by making that grouping election, we've converted that LLC from being passive income to being ordinary income associated with that farm. And I know I'm getting a little bit technical, but the reason why you guys want to look at doing that now, because before it really didn't matter. Having passive income, and actually technically the farmland isn't passive income anyway, but having that passive income we always thought was a good thing. It was always good to have passive income because it couldn't hurt you. Well, starting next year, if you have passive income and your income is above that $250,000 level, it's going to hurt you. And this is something that the CPA, when he does your tax, he or she, excuse me, does the tax return, it's going to be very easy to make that grouping election. But if your CPA isn't talking this over with you this year, you need to be talking it over with them. Does that affect your FSA? No, this is purely on your tax return. It's still going to be recorded exactly in the same spot on your tax return. You know, if you hand your tax return to the FSA or you local, the local, what are they called now? Is it still FSA? I mean, when I grew up, it wasn't called that. But when you hand it to them, it's still going to look the same. It's just how it's there's a little thing that tells the IRS, okay, these two are together. You're going to save the 3.8%. Because you've converted it from being passive, potentially. Now, it works more, the farmland gets a little bit quirky because it's got some quirky rules, but, on other stuff that you have to have passive income and you can group it, you definitely want to look at doing that. It doesn't hurt you to do it. That's the bottom line. And like I said, this is complicated rules, and we're still waiting for some regulations from the IRS on this. They haven't issued any, so we're still waiting to see exactly what we need to do, but this is something you need to be talking over. Okay, so starting in 2013, unless they change the law, there's a new 3.8% Medicare surtax on capital gains, rents, dividends, interest, royalties, passive activity income. I sort of call it the DIRP, the dividends, the interest, the rents, and the passive. That's sort of my little acronym. It's imposed, now it isn't on all of your income. First, and I'm going to talk married filing joint, you have to have at least $250,000 of adjusted gross income, and it's only on the amount of your rental income or all that income added up together that's in excess of that amount. So let's take an example. Let's say you have rental income of $150,000, rentals, interest, etc., $150,000, and your AGI is $350,000. That Medicare surtax is only going to apply to $100,000 of that $150,000. It's the $350,000, or it's the $250,000. $350,000 minus the $250,000 is $100,000. That's less than the $150,000. Now, if your adjusted gross income was $500,000, the Medicare surtax would apply to the whole $150,000. And again, this starts next year. It doesn't apply for 2011 that we're filing now. It doesn't apply for 2012 that you'll file in 2013. It's for the 2013 tax year. Any questions on this? I don't know, this came out when President Obama finally got the health care reform law through. And I don't know if you guys were seeing that fake little email going out that they were talking about that 3.8% excise tax on the sale of your house. That was because of this. That's what they were trying to say. It doesn't apply. Now, if you have a capital gain on your house that isn't excluded because of the $500,000 rule, and it's a big enough amount, you're going to pay this extra 3.8%. Right. Well, it's real estate income. Because if you have machinery rental income, that's supposed to be on a Schedule C anyway, so that's really a business. That's how the IRS views it, so it's primarily rental, yes? Real estate transactions, okay. Right, doesn't apply. Yeah, this is only if you have income. Okay, it doesn't apply to salaries and wages. It doesn't apply if you get a pension distribution, Social Security income. Income from partnerships and S corps that is not passive that it doesn't apply to, and so far it still doesn't apply to tax-free interest income. Like I said, we've sort of gone through, the planning considerations, and again, this is what we think is good planning right now. We're not sure until we see the regs. You know, some of the stuff, they may bless it, and some they may say, hey, you can't do it. But at least you need to be looking it over right now. And, you know, one way that you guys can drop your AGI and do something you need to be doing more of anyway is, you know, maximize your contributions to a 401k plan or some type of defined benefit plan, some type of pension plan. I mean, with a husband and wife, it's extremely easy to set aside $50 or $60 or $70,000 a year into a 401k plan. I mean, as long as you're making $50,000 or $60,000 a year, you can easily set aside, especially if you're age 50, if you're both age 50 or over, you can set aside $60,000 or $70,000 with a 401k plan without hardly any problems at all. You know, the offset is to be safe harbor. You know, you might have to kick in 2 or 3% for your employees, but they need to be setting something aside for their retirement too if they're good employees. That's just an aside. So, you know, we may go back to using, you know, if you're in that $300,000 range and you got rental income and interest income, maybe we go back to setting up a C Corp to get your income under that $250,000. Yeah, I don't know if it's worth the hassle to save $4,000 or a couple $1,000s of tax, but maybe it is. And, you know, in those states where you have a state income tax, you guys get a huge state, you know, if you really prepaid way too much of your state income tax liability in December and you get a huge refund, that can really bump up your AGI. Okay, we sort of talked over this a little bit already. You know, if you farm as a C corporation, you, and when I say you as the owner, the employees still would have these benefits anyway, but you as the owner, your kids, your brothers, your sisters, anything that's in your family, have the following tax-free fringe benefits. Corporate provided housing. You know, we sort of talked over, you know, the spec house that you buy, you can deduct that 100%, or if you elect not to, you get to depreciate it over the next 20 years, because it's still a farm building. You get to deduct the insurance. You get to deduct the real estate taxes. You get to deduct any improvements to the house. You know, if let's say you need a new kitchen, you get to deduct that. That's farms, you know, you guys have a lot more opportunities than other businesses that can do that. Corporate provided meals. Now this is where, you know, there's been several court cases in this area, and if you don't structure this properly, the IRS is going to win. But as long as you have some type of employment agreement with somebody, generally the spouse, but it doesn't have to be, but with, let's say you have an employment contract with your spouse that prepares the meals. She goes down to the grocery store, picks up the groceries, comes home, prepares the meal, feeds it to you, feeds it to the employees if they're around. That's 100% deductible. But if you don't have that employment agreement and you're just simply deducting groceries and you get audited, none of that's deductible. That's personal expense. So that's why semantics on some of this stuff is important. It doesn't mean the spouse is doing anything differently. It just means you have a written contract saying that she's doing what she's doing. Health insurance, now generally health insurance is 100% deductible anyway. I should say, with a C corporation, you can set up it's much easier to set up like a medical reimbursement plan, so all of your medical costs can be run through the corporation and deducted. So your prescriptions, everything that's not covered by health insurance can be deducted in a C corp much easier than it can in any other form. And cell phones are related, that's true of almost anything. I just threw that in there. But, you know, the first two are the big ones. I mean, it's very easy to have, you know, it's very easy to convert $20,000 to $30,000 or more of personal non-deductible expenses for your housing and your meals to deductible corporate expenses. And like I said, it's not available to any other entity type such as partnerships, S corps, LLCs, sole proprietors. because you don't have that necessary employer-employee arrangement other than an S corporation, but the law specifically says that if you own 2% or more of an S corporation stock, you can't have these tax-free fringe benefits. And when I say 2%, let's say you and I own 99% and you own 1% and you're my son. You're still young enough to be my son, probably. Hope so. Since he's my son, he's deemed to own 100%. So you can't look at just what the actual ownership is. You have to look at the family group. Okay, if you and I are related brothers, or if he and I are related father-son, you add together everything that's in that family group, and that's your ownership percentage. So the fact that I own 99 and you own 1, you own 100, I own 100. 99 to 1, you own 100, I own 100. That's the family attribution rules. And like I say, any new house that was built in 2011 and placed in service in 2011, 100% deductible if it's corporate provided housing on a farm. You're talking about the LLCs and so on? Yeah. You know, a lot of times when we talk, the non-tax considerations of LLC can be a whole lot more important than the tax considerations. And the way I look at it is if you have, let's say you got 10 quarter sections of land, and they're all spread out. Right now, if you own that just individually and somebody walks onto one of those quarter sections and gets killed for whatever reason, and your insurance doesn't cover it, or doesn't cover it enough, let's say the judgment against you is $5 million, just in this example. Right now, if all of that land is in your individual name, yeah, that $5,000 judgment can go after all 10 of those quarter sections. Now, if we put in any of your other property, you know, if you got stocks, bonds, and go after everything. Now, if we put that land, those 10 sections, into one LLC, now they can only go after the assets of that LLC. But the problem is, if you got 10 quarter sections, they can go after the value of those other 9 quarters. So when you start having material real estate, what I like to see is each individual quarter section or decent amount of property be in a single member LLC, just one LLC where it only has one ownership. And so then if something happens on that quarter section, they can only go after the assets of that quarter section. They can't go after any of the other 9 quarter sections. And because most people think, okay, I put all my assets into an LLC, I've protected me. Well, all of your assets are in an LLC. You haven't protected anything because all those assets are still subject to that liability. And the nice thing about a single member LLC, you can have 12 of those, and most farmers think, man, I got to file an extra 12 tax returns. You don't. I mean, a single member LLC is ignored. You still file it on that LLC, or you file it on your own personal return. I mean, so you don't have, the only extra fee you have is, each state charges, what, $50 or $75 to renew that LLC each year. Well, and that's where it's, California, don't get me started on California. Anybody here from California? I doubt it. You file an LLC return in California, it's an $800 annual fee, plus it's a minimum of $800 based on your gross income. Not net income, but gross income. So if you have an LLC in California with $1 of gross income, you pay $1,600 to the state of California. Yes. But if you have property in California, you have to file in California, even if you set it up in Illinois. Yeah. Yes, lands enslaved. They can only, and that's why if you have trucking, I think farmers, I know it's a pain, but trucking is the most highly likely you're going to kill somebody. Put those trucks in an LLC. Yeah. So then, and just leave the trucks in the LLC. Don't have your farm equipment in there with the trucks. Just have the trucks in the LLC, and then have some type of agreement between that trucking company and your farm operation. And just pay it. And, how much a mile do you pay to haul 1,000 bushels of grain right now? About the mile, $5 a mile? Yeah, just do that. Anything else on this?
On the C corp, when you address that, say you want to eliminate that down the road.
That's the drawback of the C corp. If you have time, and again, it may not be a disadvantage in a family situation, because if your whole goal is that you're passing the family farm operation from you to the next generation, and you're not going to liquidate the corporation, you don't have any extra tax. It's if you finally, hey, my kids aren't going to farm, I'm going to liquidate it. Right now, you can liquidate it, and at the individual level, it's only 15% tax. Not bad. Federal, now state, I know can add up. But the negative is, if you depreciated that, let's say you got $2 million of equipment, and you depreciated it down to zero, you got a $2 million gain at the corporate level, or you got grain that you haven't sold. There's some ways, I think using a charitable remainder trust can spread out that gain, but you do have, that's why I try to keep retained earnings, keep your assets inside that C corporation as low as possible if you're going to use it. How many people in here have a C corporation? Oh, I'm talking to the buyer. How many people in here pay commodity wages? Okay, so just 2 or 3. Nice thing about a commodity wage is that payment to you as the employee is, for both the corporation and you as the employee, it's not subject to FICA, it's not subject to Medicare tax, and it's not subject to federal withholding. So if you, right now, if you get paid a cash wage of $60,000, how much in payroll tax is the corporation going to pay? Approximately, I'm going to round it, let's say it's $5,000. How much are you going to pay in the form of Medicare, FICA? Let's say it's the normal rate. It's going to be about the same amount. It's going to be about $4,000. So on $60,000 of wages that's being paid to you, the corporation and you're the corporation, is paying about $9,000 of payroll taxes. In order to do this, the employer, when you pay a commodity wage, so let's say at the beginning of the year, you enter into agreement with your corporation as the employer that you're going to get paid cash wages of $50,000 and you're going to get 10,000 bushels of corn. So the cash wages, that's easy. You just write a check and it's very easy. But when you deliver that 10,000 bushels of corn after harvest to you as the employee or owner, let's say the fair market value on that date is $6 a bushel. So $6 times 10,000 is 60,000. Okay, so the corporation is going to recognize grain income for $60,000. It sold that grain for $60,000. It's going to have an offsetting wage expense for $60,000. So, and that's what the second bullet point is. At the end of the year, you're going to issue a W-2 from the corporation to you. That W-2 is going to reflect $50,000 of cash wages. Well, in box 1, which is your wage box, it's going to show $60,000 of commodity wages, $50,000 of cash wages, $110,000. Box 2 and box 3 and 5, whatever Social Security wages, Medicare wages, it's only going to show the $50,000 cash. And again, the fair market value of the commodity is the amount of wages. Any gain or loss, so you as the employee or the owner, when you own that grain down at the local warehouse, that's easier as at the local warehouse. Let's say a month later you sell it for $6.50 a bushel. That 50 cents difference, whether it's a gain or a loss, that 50 cents difference is a capital loss or a capital gain. And it's either short-term or long-term. If you held it for a year, it's long-term. Any carrying costs, this is where you don't want to hold it too long, but you need to hold it long enough. All those carrying costs show up as a miscellaneous itemized deduction. You need to have a written employment contract. IRS always wins when you don't have a written contract. And the employee, this is where, if you want to do it for your regular employees, which a lot of farmers do it for the regular employees, this is where it gets complicated. They have to be the owner. I mean, if it's at the local warehouse, it has to be transferred out of your farm to their name. They have to pay the storage fees now. That can be deducted when they sell it. But, they have to pay it. They have to be in ownership of that grain. And our rule of thumb, if you hold that grain for, let's say, a week and sell it, you're probably in trouble. If you hold it for a month, you're probably okay.
So for commodity wages, you got to show storage deduction.
Well, you got to, whatever the normal storage, handling, and so on, whatever that normal fees are, you got to go ahead and pay that.
So look, comes out, combine, it goes direct, you got to show
If
that's a lot of times what happens is, okay, this load, so
If the load's going to him, and he's already arranged with the elevator, hey, I know I'm going to have this corn delivered to me, it's part of my thing, I would prefer that he sold it like a month later. But, well, if it's, let's say it's delivered October 1st and he sold it a month ahead, I'd like to see him sell it as of November 1st. Yeah, you can do a forward contract sale, to get something that delays that out there. It really shouldn't impact your records because you're still showing the yield. I mean, it's still how many of you guys in here are sole proprietors? How many of you have kids under age 18? I see a bunch of gray hair. Well, we do have kids under age 18. If they're doing chores or driving the combine or whatever, of course I have a kid that's 18, so I got gray hair. Make sure that you pay them at least $5,800 a year in wages. And why do I say that? Because it's not subject to any tax. It's not subject to income tax because the child can make up to $5,800 of earned income. It's tax-free. It's not subject to FICA tax. It's not subject to Medicare tax. It is tax-free, still deductible by you. If you got 3 kids, that's an easy, almost $18,000 deduction, and they're going to spend that amount of money anyway. So,
how long does a kid have to be before you maybe how long we get from?
Well, and you got state labor laws you got to be careful of. Now, doing chores and so on, I don't know if state labor laws apply to chores. I mean, does it? I don't know. I mean, every state's different. Yeah, if you have a 2-year-old and you gave him $5,800 of wages and the IRS catches that, you're probably in trouble. Yeah. Now, I have an 18-year-old. Well, actually, I have a 20-year-old. If I paid him $5,800, I'm in trouble. So, but, it's a different matter.
If we did that,
well, that's, consider funding a Roth IRA with the wages paid. Yeah, I mean, this is a great method of starting that 8-year-old. Maybe you only paid the 8-year-old $2,000, and then the 9-year-old $3,000, and so on. But if you paid $5,000 into a Roth for 10 years, that $50,000 when they retire is easily, in today's dollars, $1 million, $1.5 million with compounding, assuming we start earning 7 or 8% like we used to. That's a big assumption right now. So, that you're paying directly to the grandchildren that are working on your farm, that answer I'm pretty sure is no. And you got to have that direct. Yeah, you could. Right, if the son's involved in the operation one way or another, but you're probably in a C corp or something else. So remember, it needs to be a sole proprietor type or a partnership. And like I say, be in compliance with your state child labor. Here's an example that I did. This was and this will probably be about what I end up on. Here's the power of having a C corporation. As a sole proprietor, if you've got $125,000 of net farm income, your self-employment tax is always bigger than your income tax. I mean, that's just, before these days of, $6 corn, back when you were barely eking out a living and you're a sole proprietor, you always paid more in self-employment tax than you ever did in income tax. So you go through this example here on that amount of income. You got income tax of $14,000. You got self-employment tax of $14,000, rounded. You get a child credit because you got 3 kids of $2,650. So your total taxes rounded $26,000. Now, if this young farmer sets up the C corporation, starts with that same 125, takes regular wages of $10,000, commodity wages of $20,000, wages to the spouse of $5,000, and pays the kids $15,000. Has the tax-free meals, tax-free housing, we come down to exactly $50,000 of taxable income for the corporation. And that's where that 15% bracket stops. So we pay $7,500 of corporate tax. Over at the individual level, we've paid a whopping $493 of tax on that income. We both have paid some payroll taxes, and you get the first child credit, and Uncle Sam pays you an earned income tax credit of about $3,000. So in this case, where the farmer used to pay $26,000 in tax, again rounded, they're getting almost a $4,000 refund, and the corporation is paying about $10,000, so the net tax is $6,000. So they're saving $20,000 for a young farmer in that $125,000 range. Compound that over 10 years, adds up pretty fast. Yes, you will have those problems 20 years down the road if you want to get the money out. But if you go through the present value analysis and so on of saving that amount of money, it adds up pretty fast. I'm Paul Neiffer from...
Well, that concludes the webinar portion of the recorded portion of this webinar. Paul, are you there?
I am here.
All right. Well, I think I just have a couple questions for you. So, one is, in your presentation there was a little bit about farm income averaging. And I wondered if you could just do a quick kind of summary pro and con of that, of using that on your operation. Okay.
Well, I can do more pro than con because I don't think there really is too much of a con.
Okay.
Essentially, let's say that you're a farmer and you've had 3 years where you earned absolutely nothing, just as an example, and then this year you earned $200,000. Well, let's make it $250,000. Right now, your income tax on that $250,000, part of it would be taxed at 15%, part of it would be taxed at 25%, and part of it would be taxed at 28%, and possibly some would be close to 30%. And that all gets sort of added on to each other. Farm income averaging allows you to go back and pretend like that you moved 1/4 of that income 3 years ago, 1/4 of that income 2 years ago, 1/4 the income last year, and since you had no tax in those years, all of that income that you sort of elected to carry back would be taxed at 15%, and then this year's, instead of being taxed at 25, 28, and 30, would also be taxed at 15%. So farm income averaging in that case would probably easily save $15,000, $20,000, $30,000. And like I say, I can't, there's really not too much of a con because A, you can elect to use it or not use it, and B, it never really necessarily raises your tax. It can only leave your tax at the same amount or reduce it.
Gotcha. All right. Well, attendees, you can plug in your questions, and I'll continue with just a few. You mentioned about paying your children and the tax advantages by doing that, and I wonder if there are any other similar kind of tax tips to kind of maybe teach children on how to begin good in financial planning, and also that would have advantages for parents?
Well, I think I'll just expand a little bit on, I think it's great that if you have a child that is, let's say, 10, 11, 12, that, almost every one of those kids are going to know Apple as a stock or as a company. They know that there's an iPhone and an iPad and so on. And if you end up paying your child a wage and then you put that money into a Roth for them and get that child involved in that process of deciding how you're going to invest that fund, and let them, you might even say, hey, I'm going to let you pick the stock or half of the money that we put in this year if you want to put it in Apple, or find a company that you think is a good company and it's going to be worth it's going to grow and so on. You get that child structured into thinking about not just the farm, but other things that are business related. I think that's a powerful tool for a kid. I was sort of a kid like that. I was, at age 10, 12, 13, I was reading the Wall Street Journal and reading Forbes and Fortune, and I learned a lot just by doing that. So I think that's very powerful. As far as tax advantages, I mean, the kids and the things that we talked about in the seminar, using a C Corp to take advantage of those non-taxable fringe benefits, that's probably the largest advantage on a consistently year after year basis.
Great. All right. Well, this is last call for questions from our attendees. And Paul, obviously you provide a lot of really great tax insight with your blog and also with your column in Top Producer. But I was wondering if there are any other good resources for general tax info and specifically farming tax info that maybe our attendees should, keep an eye on or seek for help.
Well, the one area that, believe it or not, the IRS has a very good website. It's probably one of the better websites out there. They have a lot of information that is specifically designed for farmers or taxpayers. They have the Farmer's Tax Guide. That's publication, I think it's 225 is the number of it. That publication is actually fairly good. It is a little bit, they're slant, but it's good information. There used to be some books out there on farm taxation, but the ones I've seen, they're out of print, or they're the last printed edition was maybe 5 or 6 or 7 years old, and the laws have changed so much that they aren't really too much of help. Every once in a while I'll come across something that I see, and I try to update or do a post on that in the website. But there isn't too much more than those that are specifically addressed to farmers and farm taxation.
All right. Well, I don't see any other questions right now. So, Paul, thank you so much. We really appreciate your insight. And thank you for everyone attending the webinar. And this concludes it.
Okay.